Today, we're talking about something that is eating us at 1st of January 2026. And you don't want to be caught unawares. We're talking about new Nigerian tax laws. Hello, professionals, and welcome back to the Stealth Show. Remember, the goal is to break down money, mindset, modern life without any of the boring bits. Today, I'll be speaking small jargons, but please, I shall break it down. Yeah, I'm sure you've all seen what it is that is going on now. And if you're new on this channel, please like, share, and subscribe ultimately to this channel because I'm sure you love it. You can't talk about money without talking about taxes because what is money that is not being taxed? Even scripture says, give unto Caesar what belongs to Caesar. Am I correct? So yeah, we gotta talk about taxes. I know we don't like to hear it. Even me, I don't like it too. But then, what do we have to do? It is our civil responsibility as responsible adults to comply and pay our taxes. So that, everything lasts. It's peace of mind that is the core of the matter. So as far as your state revenue is not pursuing you, the federal revenue is not pursuing you, you're running your business, you're earning your salary, investing in several portfolios, which we would also be talking about because your portfolio now is subject to taxes. So, before, short-term investments and all of those things were not being taxed and it was very attractive and safe. But I am here to announce to you that yes, there is now a 10% withholding tax on even your short-term investments. Anyway, let's dive into it. From 1st January 2026, everything changes. The laws that follow your tax deductions, your allowable expenses, your reliefs on your payee. I'm sure many people will be looking at me like, was there a relief on payee? But guess what? If you are not prepared, you shall be parting with your money. And where's the sense in that? Like I always say, it will cost you compliance, it will cost you small money, opportunities, and maybe your operational security. And we don't want that to happen. Because we are stealth world people, right? We plan ahead, we prepare, and we are not caught unawares. By the end of this episode, you're going to understand what these new tax laws are, what are the not so clear traps that you might fall into, what are the things you need to do to prepare, and what are the digital tools that can help you. I'm going to be focusing on just one in this episode, and that is drum rolls, sales and bucks. From 2026, the Nigerian tax laws would be fully digital, fully enforced, far less forgiving, and your stealth wealth will be equal to your awareness and proper documentation. And why does this matter to you? That's because enforcement would become tighter because the loopholes are closing. Income, VAT, invoices, and your bank records must be traceable. Another thing is business owners and even professionals must begin to be conscious of how their business records are being kept, and even your personal finance. On June 26, 2025, the Nigerian president, our beloved Bola Ahmed Tinubu, signed into law 4 new tax reform acts. One of them being the Nigerian Tax Act, NTA, which is a new act. NTAA, the Nigerian Tax Administration Act, which sort of explains what the Nigerian Tax Act is about. And then we have Joint Revenue Board Act, That one was designed to harmonize the federal and the state acts. And then we have the last one, Nigerian Revenue Service Act. That one is for how the enforcement will be done. And that's where we are talking about having one single body. We will no longer have the FRS. We will just have one body that will be administering some of these taxes. Why did this have to happen? Not at this time. But yes, it has happened, it has happened. So what was found out is that we have over 50 overlapping taxes. Like, there are no clear-cut distinction between several taxes we have in Nigeria. And let's not kid ourselves. You have tax, you have levy, you have rates, you have REITs, you have local governments. You pay TV and what's that one that we used to pay again? Oh, TV and radio, something to your local government, and then you pay signage. In fact, market women will pay their levy, they will pay their lodger, they will pay several payments here and there. And there are no clear distinctions between what some of these taxes are even for or what they are about. So, to harmonize all of these taxes into a few buckets. Okay, say for instance, when you're filing company income tax, for instance, we used to have police levy, education tax, NITDA, and one other one, like 4 taxes like that. Everything now has been compressed into a 4% development levy. So you pay one and that's all. So yes, it's a good thing, right? It's a good thing to harmonize all of the taxes. Another reason why government felt it was important to have this tax reform at this time is the fact that research showed that Nigeria has the lowest tax to GDP ratio when compared with its counterparts within the African continent. So in Nigeria, our tax to GDP ratio is ranging from about 6 to 8%, while our African counterparts, Nigeria is giant of Africa. And people that are not giants have a tax to GDP ratio ranging about 15 to 18%. So you see, it is just important that government does something about that. Very good. Another one that was very important to them was the fact that multinationals used loopholes in the Tax Act to come up with some profit shifting strategies, tax haven, and all of those things. So yeah, they were exempt and somewhat shielded from the Nigerian taxes. And of course, the baba of them all, revenue. What is government that cannot make money? And where will they make the money from? Of course, you and I. So what do we do to protect ourselves, Biko? That's the most important thing beside this matter. Before we talk about how to protect ourselves, right, we need to quickly talk about what is changing. I will not talk about everything because I'm not here to bore you with the jargons, like I said. I'm here to tell you what is important to you as an individual and as a business owner. So, for individual taxes, one of the prevalent tax, especially to people who work in a corporate organization, is payee, which is called pay as you earn. For personal income tax, what are the things that changed and what are the things that remained? So prior to now, the lowest tax band used to be 300,000, which would even still be taxed at about 7%. But guess what? If you're earning 800,000 and below, you're free from taxes, 0 tax. But it is per annum. If you're earning annual salary that is higher than 800,000, you start to attract taxes. It's also graduated. That's the good news. So it's not like we're slamming you with 25% at a go. It's all those oga that are earning 50 million and above Those are the people that have about 25% as their tax band. So you see, you are still covered. You and I are still covered. But up to when? Because I want to grow. So when we get to the bridge, we will cross it. What else changed? You know what they call consolidated relief allowance? That allowance that was 20%, other 20% of your earned income. The higher of 20% of your earned salary and 200,000 was a relief, alongside other reliefs, which includes your pension, NHF. NHF is that one you pay for mortgage, your HMO or NHIS, depending on the sector you work in, then your group life insurance. Those were tax reliefs that you typically would enjoy prior to now. But you see that CRA, it has been removed. But guess what? Government will not leave you without comfort. They still gave you something else. Now, you've been given rent relief, but up to 500,000 per annum. The question is, how many people pays 500,000? At least in my own area, Lagos people, how far? Please, if you pay less than 500,000, drop the cheat code in the comment section, because we might need to visit your landlord. Anyway, that's by the way. So all your other reliefs still stand, but the caveat here is that all these reliefs, especially the rent relief, is not automatic. So you need to prove beyond reasonable doubt, just like in criminal cases. Well, that was just a joke, that you have paid 500,000 as your rent. If you pay more than that, sorry, we shall not relieve you of that amount. But if it's still within that band, and in fact, your first 500, let's just put it that way, that your first 500,000 will be relieved from being taxed. So what's the good news? The good news is your first 800,000 as a salary earner is no longer being subject to tax, and you have 500,000 out of your rent that is also not being subject to tax. And for homeowners, gather here if you built your own house like me. Don't worry, I'll soon be there, I'll soon get there. The loan amount that was, maybe if you collected loan to build the house, that loan is also not subject to tax. So you can claim it as a relief if you own your own house. I think that's about it on PIT. Let's move to my business owners. So for business owners, good news is if your revenue as a business is below 50 million in a year, you're tax exempt. Isn't that some good news? But who wants to say a 50 million revenue? Sure, you don't want the business to grow. We will grow. We will grow. So, yes, when we exceed it, we will pay the tax with our full chest. The minimum effective tax rate for businesses will now be 15%. And then CGT, that used to be 10%. CGT is capital gains tax. It used to be 10%. Is now 30% as well, is ranking pari passu with CIT now. And you know, I mentioned earlier that there were some scattered taxes, police tax, NIT that, NIT def, all of those things that we used to pay before has now been consolidated to the called development levy, and that's at 4%. But the caveat here is small businesses. You know, we are the ones that we don't like to keep records of anything that is happening in our business. I just living our life haphazardly, anyhowness. Yeah, let me say it like my like my people from the, you know where they are from. That is where this matter gets really dicey. Because how do you prove to the taxman that your revenue was not more than 25 million. If you're making 50 million, but your assets, your total assets is up to 250 million, you're exempted from tax. But there are still some taxes that you pay. The tax you're exempted from is the company income tax, but you're still expected to file VAT returns. If you have withholding taxes, you need to file it. And for every other thing, proper documentation is very, very important. Also now, the expense deductibility that used to be only reasonably, exclusively, and necessarily for the business has been reduced or defined to be wholly and exclusively. So you need to be able to justify that whatever expense you're taking as deductible is wholly and exclusively for the business. If not, it will be disallowed. What that means is it will be added back to your profit and then it will be taxed. So what am I trying to tell you here? As much as it's good to be tax exempt, to be free from the burden of taxes, the other taxes that you need to remit them within the stipulated time frames, so you don't have to pay any form of penalty. VAT and withholding are payable by the 21st of the next month. So take note of that and document your business expenses, your invoices, and your sales transactions. Another thing that has been introduced is the fact that you can claim VAT impute for VAT that you have also paid. But how do you know the VAT you have paid when you don't keep the records of the payments you make, right? So you see, everywhere you look, documentation they pursue you. It is well. For my investing public, and stealth wealth people go on 29th October 2025, FIRS came up with a release that short-term instruments, short-term investment instruments will now be subject to withholding taxes. Treasury bills and all of those things never used to be subject to withholding taxes, but your interests on those investments are now going to be subject to withholding taxes. So I thought to let you know that, so that it impacts how you plan, how you negotiate for the rate you're getting on your investments, and how you can diversify your portfolio. What that means is your treasury bills, your promissory notes, your bill of exchange, your normal fixed deposit and all of those things are now subject to withholding taxes, but government bonds are not subject to withholding taxes. You see that? It's still a nice thing, right? So what that means is, if you're planning your portfolio, you can begin to look at investing some of your money in some government bond. It's neither here nor there. If your goal is to have some tax savings here and there, yes, you can invest in them, because sometimes the rates are not as attractive as what you get on some of these short-term investments. And of course, who doesn't want liquid investment? So you just want something that you can easily go to. Federal government bonds typically are usually longer tenured, so you just need to look at your portfolio and know what exactly you want to do. And don't forget, like I said, maybe this episode should be titled "Documentation is Key." Even for this as well, documentation is actually very key. For you as an individual investor, as an institutional investor, you need to be able to speak with the institution that you're investing through to help with your withholding tax records, such that you're able to claim withholding tax credit, and it can be treated as a final tax where that is what is obtainable. So you see, again, you need to talk to your wealth advisor, your the institutions you're partnering with, especially in the areas of investment, to understand what is obtainable and what they would need from you. I know that what they might need from you as an individual would be your payer ID, so that your taxes will be remitted to the appropriate tax authority and you can claim the withholding tax credit. And as an institutional investor, begin to submit your tax identification number so that the institutions you're investing through or in can help you to remit the withholding tax that is being deducted from the interest you're being paid. Note, it is not your principal amount that is being subject to withholding, it is the interest element that is being taxed. So you ask me, what's the strategy? What's the way out? What do we need to do? What should we start doing? First, if you're like me, you have businesses and you have a 9 to 5, you need to first separate the accounts. Your business money and your personal money that you have been doing any, how do they say that in Yoruba language? It stops from today. Best thing, open separate business accounts. Let your business operate as an entity on its own that can be transparently audited, and your personal accounts also being separately managed, and your funds are not moving up and down. And even if they will move up and down, proper narration and proper documentation will save you in this particular instance. When you're doing your investments, it is no longer is treasury bill, is safe and tax-free. So put all my money in treasury bill. No. What you need to start doing is to start to look at your investment portfolio a little bit more critically, so that you can start using your investment portfolio as a strategy to manage or efficiently manage your taxes. Because of course, if you're investing in federal government bonds, for instance, you are going to be saving some taxes off your investment. And if you don't mind, it's just 10% and it's withholding, I'll still claim it back in credit. Of course, why not? Now, you cannot assume that all your fixed income is tax-free anymore, because they are no longer tax-free. This one is just FYI. And now, when you're doing your return projections, you need to incorporate taxes into it. So when somebody is telling you, I'm giving you 15%, please ask them, is that gross or net? If that conversation was not your business prior to now you need to start asking, are you going to remit it? Are you going to show me evidence when you remit the withholding tax that has been deducted? Those are the sacrosanct questions you need to start asking from your investment managers now. So for investors that are looking at, how do I manage my wealth better? You need to start diversifying your portfolio, not just from a tax-free or from a risk perspective, but you also need to start looking at it from a tax perspective, a documentation risk perspective, and you need to evaluate the yield, that's the real return on your investment. You need to build tax efficient structures, that is using tax effective instruments when you're doing your investments. And then you need to use digital tools to track your investment income. You too calculate what it is that you're being given, so that you're sure that what it is that you are getting is what you really ought to get, so that you're not fighting or you're not angry when you see your interest drop into your account. Remember that stealth wealth isn't just about making money, It's about growing the money. It's about keeping your money, and it's about safeguarding what assets you've built over time. Earlier, I told you I was going to tell you one of the digital tools that I know that can help you, especially as a small business owner who might not necessarily be able to afford an ERP like them. You know them. Should I mention names? No, let's leave them. But you cannot afford some of those big names that you know. Sales Unbox is a very affordable tool that can help you manage your business process end to end, from having an e-invoice, computing your VAT, keeping that invoice in a safe archive, sharing it with your customer online, recording your expenses, having a trail of the documents that you used to incur those expenses, and ascertaining your profit at every given point in time, such that at every point you're audit ready. Because, like I said, everything is about documentation. When you incur a business expense and it's been recorded against your bank accounts, you're seeing how it moved from your bank and it's been recorded on your software, then why not? It can be allowed if it is only and exclusively for the business purpose. So some of these things are just going to help you to gain advantage over the regular business person. You can also manage your cash flow, especially in this environment. You need to know what is coming in, you need to know what is receivable, you need to know what is due for payment, and all of those things. And Sales Unbox will definitely help you. There is a version of Sales Unbox too that is coming out that will help investors to be able to track the withholding tax that is expected on their investments. So you have a tool that is all in one. Why not visit www.salesunbox.africa to get started? You see, this 2026 we are going into, and the years ahead of it, let me just say, is a year that will reward the prepared and punish the disorganized. So if you have been disorganized all along, especially with your business, I don't know, for employees like me, is the business or is the company that is like charged with the responsibility of payee and all of those deductions. So they will compel you to, it's almost like a structured environment where you're compelled to conform. But you see, any entrepreneurs, now you need to compel yourself to actually keep your records and pay your taxes on time. Because you see, non-compliance now is a real offense. So sit up, gain the knowledge you need to gain. If you need clarifications, you have questions concerning this subject, you can always drop it in the comment section on any of our social media pages. As you prepare for this new tax era, remember, knowledge is power, preparation is protection, documentation is survival, and digital tools like Sales Unbox are no longer optional. They are the real deal. So brace up for impact and put all you need to put in place to be safe rather than sorry. Thank you. Until I see you again on the next episode.